Okay. Ready for a deep dive into speculative bubbles.
Let's do it.
You sent over Irrational Exuberance by Schiller?
Yeah.
That's a classic. Plus, some analysis in Chinese about how the media hypes things up.
Right.
We're going to be focusing on U.S. stock and real estate markets, but honestly, the psychology applies pretty much everywhere.
Yeah. And what I think is interesting is how Schiller frames it.
Okay.
He doesn't talk about, like, some secret group controlling things.
Yeah.
He says that bubbles are kind of like a side effect of how we all process information, especially in the market.
So it's not really a conspiracy theory. It's more like human nature 101.
Exactly.
Yeah.
It's like, think about it. When you're deciding to buy a house or a stock, how do you know what it's really worth?
Yeah.
There's not a price tag out there.
You're right. It's all relative. And that's where we run into trouble.
And Schiller calls this anchoring.
Okay.
And it's this idea where we get fixated on any numbers that we've seen before, like recent trend stories we hear. It's like if I asked you to guess how many trees are in Central Park, but first I spin a roulette wheel and it lands on 17.
Okay.
That number 17 is totally irrelevant.
Yeah.
But it's going to mess with your estimate, right?
I can see that happening.
Yeah.
Yeah. Suddenly 17,000 trees sounds reasonable, even though I have no clue.
Right.
How does that work in, say, the housing market?
So let's say you bought your first house for $200,000 a few years ago,
Okay.
and now other similar houses are going for like $400,000.
Right.
Now part of your brain is going to be like, whoa, I'm rich.
Yeah.
But that's you being anchored to the price that you paid,
Right.
not to what the house is actually worth now.
Okay. I can see how this gets out of hand. So what about all those times people say, like, the market's booming? Is that always a bubble?
Well, Schiller says we get booms in construction mixed up with actual price bubbles.
Okay.
This is especially true in real estate. Like, those two things are related,
Right.
but they are not the same thing.
So he's saying good data on prices was hard to come by until recently.
Exactly.
So in the past, it was even harder to tell if things were inflated or just really busy?
Right. Which makes it so easy to just get caught up in all the excitement. Now let's think about those classic U.S. stock market booms. The 1920s, the 50s, and then the huge one that lasted from 1982 to 2000.
Okay.
Each one had a different new era story.
This time it's different argument.
Yes.
Yeah, we're seeing that right now with AI and the metaverse.
Totally.
But what were the stories back then?
Well, in the 20s, it was mass production and the rise of the consumer.
Okay.
Then in the 50s, post-war prosperity,
Right.
everyone was getting a house and a car.
Right.
And by the time you get to the 80s and 90s, it was all about tech globalization and the internet changing everything.
Oh, yeah. I remember the 90s tech bubble. I mean, I almost bought Pets.com stock.
Oh, wow.
I was so close. Thank goodness I didn't.
That's a bullet dodged.
Yeah. So Schiller points out how the media plays a huge role here.
Oh, absolutely.
They love those new era narratives.
Yeah.
They're exciting, they get clicks, and they sell ads.
Hmm.
But isn't that just how news works? Reporting on new and interesting things?
Yeah. But Schiller is saying it goes even deeper than that. The way they frame things, the way
Yeah.
they constantly focus on short-term gains.
Yeah.
It just primes us to think that way.
Right. Do you remember all those stories about policemen and baristas giving stock tips in the 90s?
Oh, yeah, I remember that.
And all the headlines that said the internet will change everything. It felt like the future had arrived.
Right.
And you'd be a fool not to invest.
Exactly. And all that attention from the media just feeds the frenzy.
Okay.
And, the Chinese analysis that you sent
Yeah.
it goes even deeper. They argue that the media can almost hack our attention
Mm-hmm.
and make us way more emotional. Especially when markets are going crazy, we cling to those simple, hopeful stories even more.
So it's not just about reporting the facts, it's about how those facts are presented and the narrative that's built around them.
Exactly.
Almost like propaganda, even unintentionally.
Yeah, I see what you mean. Now, this is where things get really interesting.
Okay.
Think about Schiller's example of the 1995 Kobe earthquake. It had nothing to do with U.S. businesses, but it really spooked investors, and it made them focus on all the risks in the Japanese economy.
So a seemingly unrelated event can trigger a downturn just by changing the story and the mood.
Exactly. And this was only amplified by the rise of 24-hour trading and financial news.
Right.
Suddenly, information and misinformation spreads faster, and the feedback loop is just tighter. It's like the market's on caffeine, overreacting to every little thing.
Okay, I'm getting a better picture here. We have these historical narratives, media hype, and our own brains playing tricks on us with this anchoring thing. But where does individual investor psychology fit into all of this?
That's where Schiller really digs in.
Okay.
He talks about this deep-seated need we have
Hmm.
to conform, to follow the crowd. There are experiments that show how easily we'll just second-guess ourselves and go along with what other people are doing,
Hmm.
even if we know it's wrong.
Like that classic experiment where people agree with obviously wrong answers just because everyone else is doing it.
Yes,
So
exactly.
how does that affect our investments?
Nice. Well, imagine that you see your friends getting rich off some hot new stock,
Okay.
and you're reading all these glowing articles about it. Suddenly, logic goes out the window,
Yeah.
and FOMO takes over.
Yeah.
You don't want to miss out, even if you know deep down that it's probably overpriced.
So we're literally buying into the hype because we need to belong and not be left behind.
Yeah, and isn't there a part of us that wants simple explanations?
Yeah, especially when markets are so complex and confusing.
Absolutely. And that's why Schiller talks about how much we crave those new era narratives,
Mm.
because they offer a sense of control. Like, we understand what's happening. It's comforting to believe that stocks always go up, or that this new technology will solve everything.
It's so much easier than facing all the uncertainty
Yeah.
and the possibility that, we might be wrong and that the market won't behave the way we want it to.
Yeah. And on top of that, think about how 401k plans and mutual funds, while they're great in many ways, they kind of play into this too. They were marketed as this easy set it and forget it way to get rich,
Right.
but that oversimplifies things and ignores the risks and the cycles of the market.
So even well-intentioned systems can add to this stocks always go up
Yeah.
mentality,
Yes.
especially when they have misleading marketing.
Uh,
So how does all of this fit with that efficient markets idea?
right.
That theory that stock prices already reflect all the available information.
That's the big question that Schiller asks.
Yeah.
If markets were truly efficient,
Uh-huh.
then all these long periods of irrational exuberance wouldn't exist. Prices would quickly adjust to reality.
But clearly that's not always how it works.
No.
We see these bubbles form, inflate, and then eventually burst.
Right.
And sometimes they have some devastating consequences.
Exactly. And the argument that markets are just now becoming efficient doesn't really make sense.
Right.
Because that implies that we're somehow smarter or more rational than previous generations.
Yeah. And it kind of goes against the whole point of efficient markets, but
Yeah.
it seems like people keep falling for it.
Because it's so tempting to think that with all this data and technology we have now,
Yeah.
that we've somehow figured everything out.
Right.
But what Schiller argues is that we mistake familiarity and access to information for actual understanding.
Just because, we can check stock prices on our phones 24/7
Yeah.
doesn't mean we understand the forces that are driving those prices.
Yeah, and that's where the danger is. We think we're in control, but we're still prone to the same psychological biases that have been driving bubbles for centuries.
Okay, this is getting a bit heavy. Is there any way to avoid getting caught up in this? Or is it just human nature to chase after those get-rich-quick dreams?
That's what we're going to talk about in the next part of this deep dive.
Okay.
Because Schiller doesn't just point out the problems.
Right.
He actually offers some potential solutions.
Um.
And importantly, he says that understanding our own biases is the first step to making smarter choices.
Sounds like we've got a lot more to unpack.
Yeah.
But this is already giving me a lot to think about.
Good. Because awareness is key.
Yeah.
The more we understand these patterns, the better we can navigate the markets.
Right.
And maybe even avoid getting caught up in the next bubble.
Okay, good.
Yeah. So you're probably wondering, okay, I get the psychology, but how does this actually play out in the markets?
Right.
Well, Schiller points to some changes that happened that made bubbles more likely, especially in the U.S.
So it's not just our caveman brains, it's the way the whole system is set up.
Exactly.
Yeah.
Think about the shift from those old pensions, where your company guaranteed you money after you retired, to 401k plans.
Right, where it's up to you to invest wisely and build a nest egg.
Right. Well, it sounds good, but Schiller says it pushed a lot of people into the stock market, and a lot of them didn't have much experience or guidance.
So instead of relying on your company or a pension fund manager, you're expected to become a stock expert overnight.
Yeah, and remember, this happened at the same time that trading became much easier thanks to online brokers and 24-hour markets.
Okay.
It was easier to buy and sell stocks, but not necessarily easier to understand what you were doing.
It's like a casino opening up in your living room with flashing lights and promises of winning big.
Yes. And Schiller even points out that gambling in general, like casinos and lotteries, became more popular at the same time that people were getting into the stock market.
Okay.
It's like our whole culture was becoming more okay with taking big risks.
And the media was happy to amplify those stories of getting rich quick.
Oh, yeah. I mean, it seems so enticing.
Right. Okay, so we've got The system pushing people towards risky bets and the media painting a really attractive picture.
Right.
But going back to the individual, Schiller talks about a few specific psychological things that mess with how we see value.
Yeah,
Can we go over some of those?
sure. We've already talked about how we get anchored to past prices,
Okay.
but there's also this idea of moral anchoring.
Hmm.
And it's about how our investment choices are tied to how we feel we should be living, how much we think we deserve to spend.
Oh, that's interesting. So it's not just about the numbers, but also about how we see ourselves and our lifestyle.
Exactly.
Yeah.
Think about it. Markets can only get to those crazy levels if people feel like they have a good reason to hold on to things,
Yeah.
even when they're worth way more on paper than they could ever spend.
It's like a delusion of grandeur. You're living a normal life, but your stocks say you're a millionaire, so you start to believe it.
Right, until that difference between your real life and your portfolio becomes too big and then everything falls apart.
Right. Schiller also talks about how we try to make things simpler than they are,
Yeah,
and how that makes us fall for those new era stories even when they make no sense.
exactly. We're looking for someone to tell us what it all means, even if it's all made up.
And Schiller points out that we need to justify our decisions with simple reasons,
Yeah.
and that can make us ignore evidence even when we know we're wrong.
Right. We tell ourselves stories that make us feel good, even if they aren't true.
And remember those experiments about social pressure.
Yeah.
They show how we do what everyone else is doing even when we know it's a bad idea.
It's that safety in numbers idea, even when everyone is headed for trouble.
Right. But Schiller also talks about overconfidence.
Yes.
Like thinking we're smarter than we actually are.
Yes. After the 1987 stock market crash, Schiller asked investors what they thought,
Okay.
and almost half of them thought they knew when the market would bounce back, even though no one can predict that.
It's like trying to time the waves in a hurricane.
Exactly. Good luck with that.
There's that saying, the markets can stay irrational longer than you can stay solvent.
That's a great point. You might be right in the long run, but if you get the timing wrong, you can lose everything.
And Schiller also mentions what he calls quasi-magical thinking in investing,
Yeah.
where we believe our actions can change things even when it makes no sense.
It's like having a lucky penny or wearing your lucky socks when you trade stocks.
Yeah. Okay, so we've talked about what goes on in an individual's head, but Schiller also talks about how these biases affect entire markets, right?
Think about those social psychology experiments like the Asch conformity study.
Yeah.
They show how easily we copy what other people are doing, even when it's wrong. And in markets, this can lead to huge swings up or down based purely on emotion.
It's like they say, when the crowd is running, get out of the way.
Exactly. And Schiller says that those ways we communicate, like word-of-mouth news stories and social media,
Right.
they spread these ideas whether they're good or bad. He even compares it to an epidemic, talking about how fast an idea can spread.
It's like a virus spreading through the market, infecting people with fear or greed.
Exactly.
Yeah.
And what about those times when the market calms down?
Yeah.
Is it just the virus going to sleep?
Like going dormant.
Schiller suggests something interesting here.
Okay.
He says that a big news story, even if it has nothing to do with money,
Right.
can actually stop people from thinking about speculation.
Oh, so it's a distraction that helps people think more clearly.
Right? It shows how unrelated things can affect how people feel about the market. And then there's what he calls the Mona Lisa effect.
Okay.
Remember how that painting got even more famous after it was stolen?
Yeah, just because it was in the news all the time.
Exactly. It's like that saying, there's no such thing as bad publicity.
Right.
Well, in the art world, maybe. But in the market, that constant attention, those stories, can make something seem more valuable than it really is.
Like those meme stocks or cryptocurrencies.
Right. The more people talk about it, the more valuable it seems.
Okay, so going back to efficient markets, we talked about how it doesn't explain these bubbles.
Wow.
So what does Schiller suggest instead?
Well, he doesn't completely throw out the idea.
Yeah.
He says that markets are efficient in some ways, but they're also clearly influenced by those biases we've been talking about.
So it's not, so black and white markets aren't completely rational or totally crazy. It's somewhere in between.
Exactly. And Schiller looks at history and shows that it doesn't support this idea of perfectly efficient markets. For example, he shows that stocks haven't always done better than bonds over long periods.
So that idea of buy and hold stocks always go up might not be true.
It's a decent rule for long-term investing, but you have to remember that markets go up and down, and there will be times when stocks don't do well. Schiller also says that investors haven't gotten any smarter over time. We're still making the same mistakes, getting swept up in the same irrational things.
So just because we have more information and better technology doesn't mean we're not still human.
Right. He says that what we think is learning is just being familiar with things or having access to information,
Right.
but that doesn't mean we're making better decisions.
It's like thinking you're a great driver just because you have a fancy GPS. You still need to know how to drive and pay attention to the road.
Exactly. And Schiller has some really strong evidence to challenge that efficient markets idea. For example, he looks at the relationship between price-earnings ratios and what happens to returns over long periods. And it shows that market prices can be way out of line with how much companies are actually earning.
So those high price earnings ratios, which people say mean growth is coming,
Right.
they could actually mean that things are overpriced.
Exactly. It's like a warning sign that things might be getting out of control.
Mhm.
He also compares stock prices to how much money companies will pay out in dividends in the future.
Which is what those prices should really be based on.
Right.
And what did he find?
He found that those dividend amounts haven't been as up and down as stock prices,
Okay.
which means that those big swings in the market aren't always because of how much money companies are making.
So something else is going on.
Right. Something beyond just the numbers, like those biases we've been talking about.
Okay, so we've got this conflict between the theory of efficient markets and the reality of irrational behavior.
Right.
So what do we do with all this information?
This is where Schiller gets really interesting. He doesn't just complain about the system, he offers some solutions.
Mm-hmm.
He says we need a more democratized and humanized approach to finance. One that accepts how people actually behave and designs systems that work with human nature instead of against it.
So instead of pretending everyone is perfectly rational,
Right.
we should build systems that consider people's emotions and biases. Right?
Exactly. And he even suggests creating new markets for sharing risk, like ones based on GDP or how much people earn in certain jobs.
Wow, so you could protect yourself from the risk of losing your job or your industry collapsing.
Right. It's like an insurance policy for your job.
That's pretty radical, but I like the idea. It's like taking back some control from those unpredictable things that happen in the economy.
Exactly.
Yeah.
It's about realizing that our personal finances are connected to what's going on in the bigger economy and finding better ways to manage those risks.
And it's not just about fancy new markets, right?
Yeah.
Schiller also talks about needing better education about money.
Yes.
Not just the technical stuff, but also about the psychological traps that can mess up our decisions.
Absolutely. It's about becoming aware of our own irrational tendencies, those emotional things that can make us make bad choices. It's like learning to recognize the warning signs.
So that's like financial therapy.
Yeah.
Learning to recognize those negative thoughts like, I'm missing out, or this time it's different.
Yeah.
That can lead us to make bad choices.
That's a great way to put it.
Yeah.
And it's about developing good habits with your money,
Mm-hmm.
like doing your research, thinking critically, and not letting fear or greed control you.
So it's about being a smarter investor who's more aware of what's going on inside your head as well as in the markets.
Exactly.
Yeah.
But with all this talk about bubbles and biases, doesn't it feel kind of hopeless?
Yeah, like we're all doomed to make the same mistakes over and over.
Not at all.
Yeah.
I think Schiller's work is actually really empowering.
Okay.
Because when we understand these biases, when we see the patterns of irrational behavior,
Mm-hmm.
we can become smarter investors and avoid getting swept up in the hype.
So knowing more about how things work, even if it's about our own weaknesses, is a good thing.
Exactly. And here's something else that's interesting.
Okay.
Schiller says that those times of irrational exuberance, even though they often lead to crashes, can also lead to new and creative things.
So they're a necessary evil.
Think about it. Yeah. All that investment, even if it's in the wrong things, creates new ideas, new companies, new technologies.
Yeah.
Some of it will fail, sure, but those failures can help us learn and do better in the future.
It's like that saying, every boom leads to a bust, but it also sets the stage for the next boom.
Exactly.
Mhm.
It's a cycle,
Yeah.
and we can't avoid it, but we can learn to handle it better.
That makes sense. So what does all this mean for someone who's not a professional investor, but
Yeah.
just trying to make smart financial decisions?
Well, one of the most important things is to be critical of the information you get about money.
Okay.
Don't just follow what everyone else is doing.
Right.
Don't fall for those schemes that promise you'll get rich quick, and don't let fear make your decisions for you.
So do your own research, think for yourself, and don't panic.
Right. It's easier said than done, especially when it seems like everyone is making tons of money.
Yeah.
But it's about finding that balance between staying informed, making your own judgments, and not letting your emotions run wild. And remember those biases we talked about.
Yes.
Question what you believe, especially when it seems like everyone else agrees.
It's like Warren Buffett said, be fearful when others are greedy and greedy when others are fearful.
That's a great quote.
It's about having the courage to do something different.
Yes. But that brings up another question. How do we even know what something is really worth in this crazy market?
Right. Is there a way to know for sure, or are we all just guessing?
Why should we're that easy? Schiller says we should focus on the long-term basics instead of worrying about the day-to-day ups and downs.
So ignore the headlines and the hot stock tips.
Think about the company itself. How much money do they make? Can they grow? Who are they competing with? And remember those price-earnings ratios?
Yeah.
They can be helpful, especially if you compare them to what they've been in the past.
So a really high price-earnings ratio might be a sign to be careful.
It could be. It might mean that the market is too optimistic about the future. Of course, it depends on the situation. But understanding those patterns and those psychological biases
Right.
can help you make smarter choices and not get caught up in the hype.
And don't put all your money in one place, right?
Exactly.
Yeah.
Especially when the market seems a bit crazy. Schiller talks about how diversifying your investments
Right.
can help reduce risk and make those ups and downs less extreme. And remember those new ideas he talked about.
Yeah, like markets based on GDP or income.
They could be another way to diversify and protect yourself from those big economic risks that you can't control.
It's like accepting that what happens to us financially is tied to what's happening in the whole economy. And finding ways to spread out our bets can help us get through the tough times.
Exactly. Now, this deep dive has covered a lot,
It has.
but I'm curious, what stood out to you from all this research?
What really struck me was how much Schiller focuses on the human side of things. He's reminding us that investing isn't just about numbers and charts. It's about people, their emotions, their stories. And those stories can be really powerful for good or bad.
That's a great point.
Mm.
And I think it's a call to action for all of us. Be aware of those stories, those new era stories that promise easy money or paint a perfect picture of the future.
Right.
Because they can stop us from seeing the risks, even if they're partly true.
It's like Schiller is saying, be skeptical, think for yourself, and know your limits.
That's good advice for anything in life, not just investing.
I agree. So what does all this mean for our listeners?
Yep.
Are they thinking differently about how they invest? Or maybe noticing how those stories in the media shape how they see the world?
Right.
This is something to keep coming back to, especially as new things happen in the market. There's always more to learn, and that's part of what makes it so interesting. It's like Schiller's giving us this roadmap, not to avoid the bumps, but to handle them better.
Yeah.
And speaking of roadmaps, I'm thinking about all those new era stories we see now with AI and the metaverse. Are we any less likely to fall for the hype this time around?
That's a great question. And it's something that Schiller himself thinks about in his newer work.
Okay.
He's not saying these new technologies aren't going to be big, but he says we should look at them from a historical perspective.
So don't just believe the hype, but compare it to other big changes throughout history.
Exactly. The internet was a huge deal back in the 90s, and it has been.
Right.
But did it really change the way the economy grows as much as, say, the steam engine or electricity?
That's a good point. Maybe those historical comparisons can help us stay grounded and avoid getting too excited.
Yeah.
But this whole conversation about bubbles and psychology,
Yeah.
it can feel kind of depressing.
Right.
Like we're all just controlled by our irrational impulses.
Right.
Is there any hope for us as investors?
I wouldn't say that at all. Actually, I think Schiller's work is all about giving us power.
Okay.
Because when we understand these biases, when we recognize these patterns, we can become better investors.
So knowledge is power, even
Yeah.
if it's about knowing our own weaknesses.
Exactly. And here's something interesting. Schiller says that those times of irrational exuberance, even though they often lead to crashes,
Yeah.
they can actually lead to new ideas and creativity.
So it's like a necessary evil. A little bit of chaos to shake things up and create new things.
Think about it. All that investment, even if it's in the wrong things, can spark new ideas, new companies, new technologies. Yeah. Some of it will fail, sure. But those failures can help us learn and do better next time.
It's like that saying, every boom leads to a bust, but it also sets the stage for the next boom.
Exactly. It's a cycle, and we might not be able to avoid it,
Yeah.
but we can learn to handle it better.
That makes sense. So what does all this mean for someone who's not a professional investor,
Right.
but just trying to make smart financial decisions?
Well, one of the most important things is to be critical of the information you get about money. Don't just follow what everyone else is doing. Don't fall for those schemes that promise you'll get rich quick, and don't let fear make your decisions for you.
So do your own research, think for yourself, and don't panic.
Right. It's easier said than done, especially when it seems like everyone is making tons of money.
Yeah.
But it's about finding that balance between staying informed, making your own judgments, and not letting your emotions run wild. And remember those biases we talked about?
Yes.
Question what you believe,
Yeah.
especially when it seems like everyone else agrees.
It's like Warren Buffett said, be fearful when others are greedy and greedy when others are fearful.
That's a great quote. It's about having the courage to do something different.
Exactly. But that brings up another question. How do we even know what something is really worth in this crazy market?
Okay.
Is there some secret formula or some insider knowledge that tells you when to buy and when to sell?
If only it were that easy. Schiller says we should focus on the long-term basics instead of worrying about the day-to-day ups and downs.
So ignore the headlines and all the hot stock tips.
Think about the company itself.
Yeah.
How much money do they make? Can they grow? Who are they competing with?
Yeah.
And remember those price-earnings ratios. They can be helpful, especially if you compare them to what they've been in the past.
So a really high price earnings ratio could be a warning sign.
Yeah, it might mean that the market is too optimistic about the future. Of course, every situation is different. But understanding those patterns and those psychological biases can help you make smarter choices and not get caught up in all the hype.
And it sounds like spreading out your investments is key, right? Don't put all your eggs in one basket, especially when the market seems unpredictable.
Absolutely. Schiller talks about how diversifying your investments can help you manage risk and make those ups and downs less extreme. And remember those innovative ideas he talked about, like markets based on GDP or income. That could be another way to diversify to protect yourself from those big economic risks that are out of your control.
It's about understanding that our own financial well-being is connected to what's happening in the broader economy and finding ways to manage those risks more effectively. Spreading out your investments can help you get through those tough times.
Exactly. Now, this deep dive has covered a lot.
It really has.
But I'm curious what stood out to you from all this research. What really resonated with you?
I think what stuck with me is how much Schiller focuses on the human side of investing. He's reminding us that it's not just about numbers and charts. It's about people, their emotions, and their stories. And those stories can be really powerful for better or worse.
That's a great point. And I think it's a call to action for all of us. Be aware of those narratives, those new era stories that promise easy riches or paint a perfect picture of the future. Because those stories can blind us to the risks, even if they're partly true.
Yeah, it's like Schiller is saying, be skeptical, be thoughtful, and know your limits. And that's good advice for anything in life, not just investing.
I completely agree. So what does this all mean for you, our listener? Are you rethinking your own investment strategies? Or maybe noticing how those stories in the media shape how you see the world? This has been a deep dive that's worth revisiting, especially as new trends emerge. There are always more to learn, and that's what makes it so fascinating.
It is, isn't it? The markets are always changing, and so are we. But understanding those underlying forces, both the economic ones and the human ones, can help us all make better choices, navigate those uncertainties more confidently, and maybe even find some opportunities along the way.